Hi everyone, Ruben Torrens here again on video number 3. On this one, I will review a copy of the Statement of Contributions from Canada Pension Plan. So let me take you to the statement, straight to the statement, and go through the information that is contained on the statement, how to use that information, and of course how to get the statement. What I got here is a copy of a statement from last year that this statement shows your contributions, how much money you contribute every year to the Canada Pension Plan, and your pensionable earnings, how much money you earn that is calculated to pay Canada Pension Plan. So, and this does this year by year. This person in 1974 contributed $5.80 and had a base income of $418 for the year. As you can see, there are another two columns. These are because of the latest pension reform, the latest CPP reform, but they didn't take effect. Well, actually, the first portion took effect in 2019, and the second portion doesn't take effect until 2021. There are also letters beside the numbers sometimes, and the letter M, which is the most important letter, shows that this person has reached the maximum contribution for that particular year. And this is important because the contributory period to Canada Pension Plan starts at age 18 and ends at age 65. There are 47 years, and you need to contribute maximum for 39 out of the 47 years in order to receive the maximum benefit at age 65. So this is very difficult, and this is the reason why most people do not receive maximum Canada Pension Plan at age 65. But this is all basic information. So if we scroll down to the second page, on the second page it shows the benefits, and it shows the retirement benefits, and it also shows disability benefits and death benefits as well. The death benefits and the disability benefits are excellent for financial planning purposes. But for retirement planning, I like to concentrate on the benefits at age 65 and at age 70, which are the note right here, how much you will receive per month at age 65 and at age 70, this is assuming that you're retiring at 65 and you're not going to collect Canada Pension Plan until age 70. And by the way, many people may tell you that the information on the statement of contributions is not accurate, that when you retire, you will receive a different amount. And this is true, it's not accurate, but it is accurate enough to do what I will show you on how to do it. So just bear with me. But before getting into that, what I'd like to do is show you how to get this statement. So one way of getting it is by sending an application for the statement of contributions. This is a very simple application, only one page, very basic information about yourself, your signature, and includes the address where you have to mail this form. And in about 4 or 5 weeks, or a little longer maybe because of the pandemic, you will get a statement on the mail. How to get this form? This form has a number here. Every pension form has this ISP that stands for Income Security Program and a number. In this case, it's 2000. So if you Google ISP 2000, you're going to get to this page and just click on the application, download the form, and there you have a brand new PDF fillable on your computer. Another way to get not this form, not the statement itself, but the same information that is on the statement. To get the statement, you can only get it by sending this application. But the information on the statement is on My Service Canada account. If you Google My Service Canada account, and you click on My Service Canada account, well, you can log in from here if you have your login information, or you can apply for My Service Canada account and log in here. You simply have to follow the instructions to get your own My Service Canada account. Be very careful if you get My Service Canada account. Don't share that login information with absolutely no one for no reasons, because this is your life, this is your safety. Okay, so you have to be very, very careful with that account. But in here you will find a My Service Canada account. You will find information about your retirement, about your employment insurance, and a lot of information. It's an account that is good to have because you can do a lot of stuff from there. Okay, this is so cool, but what to do with that information? That's what I will show you next. And this is what I call retirement planning on a napkin. So get a pen and a piece of paper and write what I will show you, and you will see how to use that information. So this is my piece of paper, and this is what I want you to write here. Just write CPP for your Canada pension plan. Other, for this will represent, here you will write any other income over which you have no control. Let's say you have a pension from another country that you will receive no matter what. Let's say you work for an employer that offers a employer pension, then you will receive that money. So do not include money that you will save under your own will, such as RRSPs. So anything that is taxable but you have no control, you will receive it. And your total monthly, then you times 12 to get your annual amount. And you will do this for age 65 and age 70. Look at your statement of contribution from Canada Pension Plan, what it says that you receive at age 65, and then you write down what you receive at age 70 here. Okay, like this. Like let's say you have 700 at age 65, you will have 994 at age 70 if you don't touch it. If you are single, you write the number that you have at age 65. If you are a couple and you want to do this, you write the number, you add the two numbers, the two statements of contributions from both partners in the couple. You just add them together at age 65 and for age 70, and you enter them as a single amount. For other income is what I told you before. So bear in mind that we are not including old age security here because it's not part of this calculation. And then you write to your total monthly that you will receive and your total for the year. Okay, so and these numbers are important. You will see why. But let's throw another example. Let's say you are a couple here, clearly a couple, because if you receive at age 65 $1,400 per month, it must be a couple. So the maximum for a single person is $1,203, so $1,203. So let's say this is a couple, and in addition to Canada Pension Plan, they will have another pension or whatever that will receive for $500 per month, and it won't change if they delay to age 70. And this will be the total for the month, and this will be the total for the year. So what to do with this? Well, here it is. If you're single, your guaranteed income supplement maximum will be $936 if you have zero income. And this $936 will go all the way down to zero if your income goes to $19,000, let's call it. And if you're a couple, same thing. Your guaranteed income supplement maximum for the period July to September 2021 will be $1,127. This is both partners together, both spouses together, added together. And the threshold is $25,000. If you earn this or more than this, then you get zero. So if you earn half of this amount, then you will get about half of this amount. And if you earn half of this amount, then you will get half of this amount. So, or just about it, just around there. Okay, so if your income, your total taxable income, will be $8,400 at age 65 or $12,000 at age 70, well, you are quite away from this amount. So that means that your guaranteed income supplement will be probably high, most likely. So you want to avoid any other taxable income at age 65 because it's going to be too costly. For every $1 of taxable income you will have at age 65 or over, you will lose 50 cents of your guaranteed income supplement, or more than that, depending how much your income is. So you have to be careful with that. And with a couple, same thing, same situation. Like for example, if this is the situation and you're a couple and by age 65 you're going to have $23,000 of income, almost 23,000. Well, you are very, very close. Your guaranteed income supplement will be very, very insignificant because you're too close to receive zero. So go ahead, and if it's tax wise, it's a good idea to save another space. Go ahead and do it. But if you happen to be a couple in this situation here, making $12,000 of income, then stay away from anything that is taxable, that will be taxable in the future, because it's going to be too costly. And this is how you use and how I use the statement of contributions to calculate my clients and to help my clients to achieve the highest possible income at retirement. In future videos, I will show you a lot more than this. I hope I explained myself correctly on a complex topic, and I hope you enjoy the video, guys, and you get something out of it, some ideas. Don't forget to subscribe. You're gonna help yourself and you're gonna help me. It's free. It doesn't cost you anything. Nobody's gonna contact you. And I will see you on the next video. Don't miss that one. This is about the pitfalls of the pension process. This is gonna help you to save not only money but a lot of headaches. So thank you for watching, and I'll see you there.